William Ackman's lemonade stand case study distills the essentials of finance and accounting into a simple, relatable example. By examining how a small business tracks capital, manages its balance sheet, and measures performance, Ackman illustrates why these fundamentals remain critical at every level of business. In this episode, we'll unpack the lessons from his lemonade stand and connect them directly to the financial strategies of leading corporations. You'll see how the same core principles that guide a child's summer venture also shape billion-dollar decisions in the boardroom. Understanding these basics sets the stage for mastering more advanced financial strategies. If you're new here, please subscribe and like, because I share tips to help you improve your career. Let's break down how Ackman's lemonade stand blueprint explains the building blocks of financial management and why these same principles hold true for global corporations. The lemonade stand model starts by introducing the three core financial statements: the balance sheet, income statement, and cash flow statement. Whether you're selling lemonade on the corner or managing Apple's product lines, these documents provide the essential view into how a business operates, how it grows, and how it survives. On the balance sheet, a lemonade stand tracks cash, inventory, and equipment, just as a major company accounts for assets and liabilities on a much larger scale. Ackman highlights the importance of understanding working capital, making sure you have enough resources on hand to meet day-to-day expenses. For example, Apple's supply chain management is a direct extension of this principle. Apple uses its strong balance sheet position to negotiate better terms with suppliers, ensuring it can secure inventory without straining cash reserves, much like a lemonade stand owner who plans ahead to avoid running out of lemons on a busy day. The income statement is where you measure profitability. Ackman's lemonade stand tracks revenue from each cup sold and subtracts costs like sugar and lemons to find profit. This mirrors how Apple analyzes the profitability of each product line, focusing on gross margin to understand which products drive the most value. Amazon's relentless focus on operating efficiency, finding ways to grow revenue while keeping costs in check, follows the same logic. If a lemonade stand spends too much on ingredients, profits vanish. The same is true for a tech giant with ballooning operating costs. Cash flow, according to Ackman, is the ultimate indicator of business health. Even a profitable lemonade stand can fail if it runs out of cash to pay for supplies or rent. This lesson is just as critical for companies like Tesla, which have had to carefully manage cash as they scale production and investment. Tracking inflows and outflows, making sure you actually collect payment before spending more, remains a universal requirement. The lemonade stand framework extends to capital raising and investment decisions. Ackman shows how raising money through selling shares or taking on debt at the lemonade stand level is directly comparable to how corporations fund expansion or new projects. The distinction between debt and equity and the calculation of return on investment are concepts that scale up from the sidewalk to the boardroom. Today, even as technology transforms how transactions are recorded and managed, the underlying financial statements and their logic remain unchanged. Blockchain now streamlines supply chain finance, automating payment flows between suppliers and buyers. But whether a transaction is logged on a blockchain or in a notebook, the fundamentals of tracking assets, liabilities, and cash don't change. By studying these building blocks in their simplest form, you gain perspective on why financial literacy is essential at every level. As automation and AI begin to reshape the accounting landscape, understanding these basics ensures you can adapt and make informed decisions, no matter how advanced the tools become. If you're finding this helpful, please subscribe and like, because it helps us create content that matters to you. Also, if you want to take your skills further, check out our executive education and executive coaching programs at execbeat.com. The landscape of finance and accounting is rapidly evolving, moving from traditional ledgers to advanced technologies like artificial intelligence and blockchain. Companies now use machine learning to automate transaction processing and analyze large datasets, allowing for faster and more accurate financial forecasting. Predictive analytics, once the domain of experienced analysts, are increasingly driven by AI models that can identify patterns and anticipate outcomes, giving executives more timely insights into cash flow and risk. Blockchain technology is also reshaping supply chain finance by providing transparent, secure records of every transaction. Distributed ledgers allow businesses to track goods, verify payments, and automate contract execution with smart contracts. This reduces manual reconciliation and shortens payment cycles, but it also requires organizations to rethink vendor onboarding and invest in new training for their teams. ARI's impact extends to risk assessment and compliance monitoring. Financial institutions can now monitor risk in real time using algorithms that process historical data and emerging market trends to spot vulnerabilities earlier than traditional methods. This shift mirrors Ray Dalio's emphasis on understanding both short-term and long-term debt cycles. Continuous monitoring enables companies to adjust strategies before risks escalate. However, these systems bring new challenges. Executives must ensure data quality and remain vigilant against algorithmic bias or unintended consequences, which can arise when models rely on incomplete or skewed data. Despite the promise of automation, the human element remains essential. Many organizations find that blending automated systems with human oversight prevents errors and improves judgment, especially for atypical or complex transactions. For example, some finance departments automate routine expense approvals, but rely on staff to review exceptions, striking a balance between efficiency and accuracy. As regulatory frameworks adapt to these innovations, companies face growing compliance demands. Disclosure requirements for AI-driven financial advice and evolving standards for blockchain-based transactions push finance leaders to maintain flexible, robust infrastructures. Navigating this environment requires not just technical adaptation, but a strong grasp of core financial principles. This convergence of foundational knowledge and technological advancement shapes the future of finance, setting the stage for those who can integrate both to lead effectively in a changing world. Building on Ackman's lemonade stand example, the most effective finance leaders rely on simple benchmarks. Does your working capital cover daily operations, and are your margins improving as you grow? These tests, drawn from the lemonade stand's balance sheet and income statement, reveal the true health of any business, no matter the size. While technology like AI and blockchain continues to reshape the field, the basics remain unchanged. Accurate statements and sound judgment are still the foundation for any innovation. Review last quarter's balance sheet today through the lemonade stand lens. What jumps out? Thanks for watching. Please subscribe and like, because it helps us bring you more free videos. And if you're ready to grow your career, visit execbeat.com to learn about our executive education and coaching.